Welcome to our Green Up TV show. Good morning, everyone, and thank you for all our viewers for joining us. Let's start this first session this morning. We will raise the question, is carbon pricing a moonshot? I am Laurie Chenet, your host this morning, along with my co-host Ivan Pavlovich. You are an energy transition specialist at NATIXIS CIB Research. Good morning, Ivan.
Good morning, Laurie. I'm very happy to be with you today and to explore this very timely topic with lots of interesting developments all across the globe. Before we turn to our esteemed guests today, let's see what's going on in Europe with the emissions trading scheme.
The European Commission's Fit for 55 showcases the EU's most radical use of carbon markets to date. It includes a comprehensive package allowing the EU to achieve a 55% reduction of greenhouse gas emissions by 2030 and aims to accelerate the phase-out of fossil fuels. It introduces binding sectoral policies with stringent targets for the production and adoption of low-carbon electricity and molecules. Fit for 55 strongly emphasizes carbon pricing as a key enabler to its ambition. This revolves around a twofold approach. First, Fit for 55 tightens rules governing the EU's emissions trading system by accelerating the reduction of allowance allocation and extending sectoral scope. Second, it introduces the Carbon Border Adjustment Mechanism, or CBAM, covering multiple sectors. CBAM intends to create a level playing field between the EU and its trading partners by forcing EU importers to pay for the carbon content of their goods. Through these measures, Fit for 55 positions the EU ETS as the world's most advanced compliance carbon market.
So it's interesting to see that the EU ETS is set to be at the forefront of EU's decarbonization effort. Beyond this fairly stable and liquid carbon market, we see a much more diverse global markets scene. So to help us dive into the variety of carbon pricing systems across the globe, we are very happy today to have on scene Malika Eshwaran. You are Chief Group Economist at Shell. We have Marieke Fransen. You are the Head of Global Commodities Financing Solutions at NATIXIS CIB. And we also have Albert Chang. You are the Global Head of Transition Analysis as well as Deputy CEO of BNEF. So probably starting the questions with you, Albert, and taking probably a step back and looking at the global geopolitical scene. We cannot ignore the recent US election as well as the ongoing COP29 summit in Baku. So how do you view the global carbon market scene evolving?
Thank you. Well, globally, we've seen a growth and expansion in the number of carbon pricing schemes over the last few years. So we now track 60 global pricing 60 national and jurisdictional pricing mechanisms around the world that cover about a quarter of the world's emissions now. So that's quite meaningful. And it's in places like the EU, the UK, parts of the US, so state level in the US, China, Japan, Korea. So many of the major economies now have some form of carbon pricing mechanism. And that's been growing, over the last few years. We estimate that the traded volumes within the traded mechanisms globally account for about $800 billion per year in traded volumes. And actually, the vast majority of that is the EU emissions trading system because it's the most robust, it's the largest, and it's the most highly priced. There isn't a global carbon market, but there are lots of many individual carbon markets. And I think what's interesting is to kind of look at the places where there might be a little bit more global interaction between those markets over the coming years. So we've seen things like the voluntary carbon markets, the CORSIA scheme for aviation, where there's more of a global element to it. The EU CBAM, which was mentioned in the video, is going to start to, in essence, kind of spread an EU shadow carbon price into other parts of the world, where industries that want to export to the EU will have to in some way align to kind of EU carbon pricing. And then, as you mentioned, in Baku, we saw some progress on Article 6 of the Paris Agreement. Now, Article 6 essentially says that countries should be able to trade emissions reductions with each other. That it is already in principle creating bilateral trades of you could call them carbon offsets or carbon credits between countries. And the announcement that was made last week at COP29 was to formalize the standards for what's called Article 6.4, which is to do with how countries and also companies can trade emissions with each other. So there is progress being made on that. We need to see more progress, so it's not really fully ready for operationalization yet, but it's encouraging to see those standards coming through, and hopefully there'll be more progress in the coming days.
Thank you, Albert. Turning to you, Marika, as a daily participant to compliance markets, the EU as well as other jurisdictions, how do you view the global dynamics of carbon markets?
Yeah, it's a very interesting question, and I think Albert is point on, right? Because if you look at the EU ETS, this is very, very well established and by far accounts for the largest proportion of what we call the global carbon markets. They're also well ahead in terms of pricing of other markets. I mean, the average global carbon price is about $25 a ton this year, whereas if you look at the EU ETS, the price currently trades around 69 euros a ton, which gives a big gap between the two markets. CBAM, I think, is an interesting development in the sense that it could potentially have the EU ETS become a benchmark for the rest of the world and hopefully converge the markets a little bit. That said, you know, from discussions with clients, you can see that for a lot of people it also still feels like it's a far away program, even though 2026 is around the corner, as we all know, and ideally you have to start hedging. I think the other element which is very interesting about carbon markets specifically is that, you know, EU ETS, I think, has proven to be a very stable market. You know, I think a lot of people don't recall anymore, but when it started up in 2005, it faced a lot of the same problems as voluntary markets are facing at the moment. There was a lot of fraud, people didn't trust the system, but the market has evolved, it's stable, it's got a price that's set, but that price is also still very much driven by politics. You know, I think the European Union, through the market reserve, through Repower EU, is sort of setting the scene that this market is bullish overall, which all global markets are. And if you see across the different mandatory markets across the world, they're all bullish, all for that same reason. And that also makes, I think, the regulatory aspect of it the most challenging one. So yes, I think that going towards a global market seems to be the direction. EU CBAM hopefully is gonna set those first steps. I think Corsia is very promising in that it hopefully starts bringing together mandatory and voluntary markets, but there's also still a lot of work to be done.
Thank you. Question for you, Malika, as an emitter of CO2. To what extent these carbon markets are already influencing Shell's operation? And we've seen the variety and the numerous number of existing carbon markets. So do you perceive some geographical discrepancies?
Yep, thank you for the question. Pleasure to be here. I just want to reiterate and add a little bit to what Albert said, that we do see carbon markets proliferating across the world. More and more geographies are choosing to price carbon, whether that's through a trading scheme or through a tax is open, but we see that progress. And we saw that progress even over challenging times through COVID. So that didn't stop the sort of development in this direction. Now, we are regulated under the EU ETS in Europe, many of our assets and installations. And so again, if you look at the last 10 years, the EU ETS price, the allowance price, has gone up more than tenfold. And that has had an impact in terms of making us look at our assets in terms of how do you improve the energy efficiency of it? How do you look at alternative fuel sources as a way of reducing some of the costs that we would have to pay to cover the allowances? So we've already seen the development, the reforms and the changes in the ETS driving sort of changes in what we invest and how we invest. I think going ahead, we look at today the EU ETS over 65 euros. I mean, that's sort of a huge change over in a decade. And we see that going up to 2030, inevitably, because it's being aligned with the Europe's targets in 2030 and then now 2040. So we do see that going up, and we expect that to, is playing a part in our thinking around investments in, for example, carbon capture and storage. Because of the expectation of higher ETS prices, many industrial producers, manufacturers in Europe are looking to how do you deal with their emissions. So with the expectation that the EU ETS price will be high, we are getting sort of new business models emerging to take away the carbon and store it permanently. So we have a project in Norway called Northern Lights that does exactly that. Now, there is a huge geographic divergence. But as Marike was saying, that CBAM is having an impact. So when we go and when I travel to places like China and India that are looking at Europe as a very important export market for them, they are looking at the CBAM and thinking about how do they put in measures that would mitigate the impact on any potential exports they want to do into the EU. So again, because of the CBAM and because of the EU ETS that it rests on, you're seeing that that's driving action in many countries to also put in pricing schemes and mechanisms so that they're then compliant and fall in line with the EU's ETS.
And now if we take a more global perspective on energy transition, coming back to you, Albert, in your views, do you see carbon pricing mechanisms are relevant to serve our actual decarbonization effort? And if you see potentially any complementary tool to carbon pricing mechanism to support energy transition globally?
Yeah, we're very, very clear on this, is that carbon pricing is necessary but not sufficient to drive the level of decarbonization that we need. Clearly, it's necessary because you need some form of mechanism to incentivize, the gradual decline and phase down of polluting technologies. But what we've seen over the last 20 years of experience in the energy transition is if you want to deploy new technologies, especially new technologies that are not yet commercially mature, you need other incentives to drive them. So you needed strong feed-in tariffs to drive the adoption of solar and wind 15, 20 years ago, because those technologies were not economic. And the carbon price you would have needed back then to promote those technologies would have been really punitive and would have hurt the economy. So targeted subsidization was needed to drive those technologies down the cost curve to the point where they can now compete. But even today, many of those technologies can't survive just on a carbon price because it is a traded instrument. And therefore, there's going to be volatility. And if you're making a 25-year investment in a certain power plant, sometimes that volatility actually can hurt the investment case. So that's why you see things like contracts for difference, either for power prices or increasingly contracts for difference for the carbon price to drive some of the new investments being made in industrial decarbonization. And I think in industrial decarbonization now, we're going to see the same challenge for deploying clean hydrogen, carbon capture and storage, these new emerging technologies, which, again, today are where wind and solar were 15, 20 years ago. They need targeted subsidization and demand creation to get them going alongside the carbon pricing mechanisms that disincentivize fossil fuels. So I think it's always about having the carbon pricing alongside other policy mechanisms.
Turning to you, Malika, as an emitter, how do you view such tools as internal carbon pricing? To what extent do you consider these tools can be supportive of your own transition journey?
So yes, so we at Shell, interestingly, have had a internal carbon price that we've used for investment decisions. And this has been for years now. And the nature of that internal price has evolved. So we started with a single price that we would apply across all projects. We now have something that's geographically differentiated based on countries' NDCs, their nationally determined climate contributions, and also the credibility of policies to drive towards that target. And we also now have a trajectory. We assume that there's a rising carbon cost across most, if not all, geographies. And so that goes into our investment appraisal and project appraisal process. Now, to be honest, till now, it's been a really good way of de-risking mainly fossil investments. So when you're making those investments, to understanding what are the nature of the risks to that investment, because we've been investing for a long time, right? So we'd be investing for decades, and these are capex-heavy investments. So it's been a very good tool to check and make sure that whatever we're doing is robust, or the risks are managed around those. I think looking ahead and looking at the trajectory we see the price going to, it's going to more and more push us into opportunities that are emerging in the low carbon space. So the EU ETS price is a big piece of the puzzle for us. When we've invested in Netherlands on offshore wind, combined with a hydrogen electrolyzer project, whose output then goes into our refinery to reduce the refineries' emissions. So this the ETS price has been a big part of that. As I mentioned, our carbon capture project in Norway is a big part of that, is again built on expectations around the CO2 price. We have EV charging networks that we are investing in. And also it's driving opportunities and new investments in new low carbon opportunities. So that helps us meet our target for 2030, which is to reduce scope 1 and 2 emissions, which is from our assets, by 50%. And then by 2050, we expect to be a net zero emissions energy company. So it helps us now make that journey.
Interesting. Maybe just to open the discussion with more forward-looking elements. Interesting, maybe, Malika, to see how do you see the voluntary and the regulatory markets potentially emerging, going together just to respond to the need of the transition. You are mentioning the difference discrepancy, but to what extent it will converge? And actually, what's next for carbon pricing mechanism in global markets?
Interesting, very interesting. So I will put myself a little bit at risk here by making some forward-looking statements. So I think there is a lot around the compliance markets will continue to develop and evolve. We think that's, and they will be the ones that will set the rules in terms of standards for credits and offsets, in terms of disclosures, transparency. And I think the voluntary market will move towards those rules and converge. In that sense, there'll be a convergence. Now, for us, we obviously use credits, offsets, carbon dioxide removals are a part of the kind of portfolio of things that we expect we will need to use to decarbonize. But it really is not the primary focus. Primary focus is to reduce emissions, so mitigate. And then for those emissions that are very expensive or very difficult to remove, then we expect there will be a role for carbon dioxide removals, offsets, et cetera, to then address those emissions. So I think there is a sort of a role for that, but it's sort of within the context of the wider decarbonization effort that we're going to do. I think going forward, it is inevitable. We think that the carbon, as I said, the carbon markets and carbon pricing, tax or trading, will expand across the world at different paces, but it's inevitably going to happen. We think it's on an upward trajectory, and I think there will be reforms and changes, like we have seen with EU ETS in the last decade, as these markets and these instruments are tuned to respond to circumstances and to respond to government ambition. So I think that inevitably there will be changes, but the overall trajectory, we think, is going towards a higher carbon price and a more predictable carbon price.
Well, another forward-looking question for you, Albert. EU ETS is unquestionably the most liquid and advanced ETS in the world. So could you share some price projections through to 2030?
Yeah, sure. I mean, I'm curious to hear Marika's view as well. But so yeah, maybe just to look back over the last couple of years, the ETS price has actually fallen slightly because emissions in the EU have fallen too. And so there's a supply and demand of credits, and the success of the growth of renewables in Europe has actually driven down power sector emissions quite rapidly over the last year or two. And that's actually led to prices being, trading in the sort of high 60 range per ton. Going forward, what's going to happen is that emissions cap is going to keep coming down, as was sort of very well explained in the video. And so you're reducing the supply of credits in the market. And so the places where you're going to be able to find carbon reductions in the economy are going to get fewer and fewer. So there's still a few years left of the power sector being the place where that happens. So you're essentially taking coal and to some extent gas out of the power sector and replacing it with renewables and low carbon energy. And so you can get quite far down the road of reducing your cap through that sector. But over time, that starts to run out because the power sector becomes very, very clean. So if you want to keep reducing emissions, you have to look elsewhere. And it seems like that's going to be in industry. So in the heavy industries that are part of the EU ETS today. There are other sectors being included, as we talked about before. But industry seems to be where most of the next wave of reductions is going to come. And those reductions are going to be more expensive because you're talking about industrial electrification, industrial adoption, of new technologies like hydrogen, carbon capture, potentially more bioenergy, things like that. So we actually see the price going from, somewhere in the mid-60s euros per ton today to more like 145. 145 is the price forecast from our team in 2030 at the moment. So it's more than a doubling. And we think that price is enough to support industrial decarbonization at the levels needed to kind of get on track for that Fit for 55 cap towards 2030. But would love to hear if my fellow panelists have any other opinion on that.
May I invite you to react, Mike?
Yeah, no, of course, of course.
Your carbon scenario then.
Yeah, no, we're not so different in how we view the markets. I think what is sort of interesting is throughout the market, I don't think anyone has a different view of where we're going to be long term, right? I mean, I think the supply is a bit pre-programmed just because of how the EU ETS through the reserve almost has a central banking tool with which they can manage the supply. And therefore, long term, we see tightening, we see price going up. What is going to happen in the coming 2 years is more the key question, I think. And obviously, in 2024, we've seen a little bit of an on-off relationship between EUAs and gas. I think, the energy crisis has resulted in the fact that, investments in renewables went a lot faster than the European Union had anticipated. And so if you look at Repower EU, which assumed a very conservative price of 75 euros a ton, we're now below that. And so in order to raise the 20 billion that this program needs to raise, you now need to add more carbon credits to the market, i.e. you add more supply, which gives a bearish pressure on the price. That said, we've seen a floor, and I think that floor is going to hold. So overall, I think, this is not just my view, but obviously we have a research team that also looks at this. And I think in the coming 2 years, we see it slightly bullish. From 2027 onwards, we really see it going towards the levels that Albert is indicating. And I think CBAM will be very important. Obviously, next year, end of next year, there's the review of CBAM. And what happens there can also sort of drives whether it really goes to 145 or if it stays a little bit in the lower hundreds. But that it's upwards is a given, I think.
Maybe going to you, Malika, your carbon scenario projection. What do you think? Jumping on Albert's comment.
So I can't actually reveal what our internal carbon pricing is. But I think I'm agreeing with this. The trend is in the EU ETS for higher prices. I think there will be movements that respond to circumstances, like you mentioned with the build out of renewables, beating expectations, etc. But I think overall the trend is definitely rising. And I think just to add to that, I think carbon pricing is the most efficient instrument to deliver reductions, and that's what you'd expect an economist to say. But I think we're only in the early stages, really, of the transition. And as you move towards 2050 targets, the complexity and the scale of the transition is only going to get bigger and bigger and bigger. And for that to have a regulatory approach where you're trying to regulate emissions becomes hugely, firstly, it puts a huge pressure on policymakers and also adds a huge regulatory burden. So I think it's inevitable that there will be increasing reliance on market-based measures like carbon pricing to deliver some of this as a way of keeping a lid on some of those costs that might happen if you try to regulate everything. As a business, we love the idea of market-based measures and carbon pricing because it gives businesses the opportunity to innovate and come up with solutions that maybe are not obvious, may not be obvious to the market, to the policymakers. So I think that is the other big advantage of having mechanisms like trading and tax that are market-based.
Thank you. Maybe final question for you, Marieke. Do you see new global opportunities for commercial banks in order to respond to the evolution of the global market that we just mentioned?
Yeah, no, absolutely. I think the EU ETS is currently a well-banked market. It's a market that's established, it's a market that sets itself, and it's a market with standards and integrity. And I think that is the most important thing. As Albert said in the beginning, at COP29, we've seen some positive news coming out that they are agreeing on some standards for Article 6.4. I think we're not there yet that it becomes really bankable. I mean, for a lot of banks, you know, you need more standards, you need regulation, you need that integrity in the market, and we're not there yet, but there is a positive trend. And I'm hoping that also Corsia is going to be a tool where if these two markets starts converging together, there is a little bit more to do from a banking perspective. But what is a given is with a bullish outlook, more liquidity is going to be needed, and there is a big role to play for banks like NATIXIS.
Thank you. Any reaction, Albert, on this one? What are the opportunities that you see for the market globally?
Yeah, I think I would go back to the beginning just to say that I think carbon pricing is an incredibly important tool. I agree with Malika on the efficiency point. A couple of years ago, somebody very famous said that carbon markets are going to be a one-way bet. I think maybe probably in the long term that's true, right? In the long term that's true, but in the short term you never know. No. But I think we would all agree that in the long term this is going to be something that's going to be here to stay, and it's going to drive decarbonization for sure.
Okay. Thank you, everyone, and especially a special thanks to our estimated guests for your valuable insights. Coming back just after a short break, we will deep dive into green hydrogen, and we will raise the question about the merit order mechanism regarding to the end use of green H2. Is it expected, relevant or not? Stay with us. Thank you.